Hi, this is Tom Alexander with Alexander Trading. This is a member trade lesson, and this lesson is inspired by today's trade in the stock index futures. Now, the day is not over. We've got about another, I don't know, hour and 45 minutes or so before the day's complete. But I was sitting here and I was thinking about what's going on in this market right now, and one of the things that I have learned over the years, I've been trading I'm in my 30th year of trading, and I've seen trading education digress. It's actually gotten worse. But one of the commonalities of the 28 years is that almost all traders want to, and almost all traders are taught to, fade the market. Now, I'm not going to get into all the reasons why they want to fade the market, and there are some semi-logical reasons that people want to do that. But the problem with fading the market is that when you run into what is referred to in auction market trading or market profile trading as the initiative move, you get run over. And fading the stock index futures has always been popular, trying to scout 2 or 3 ticks. If the S&P moves 4 handles up, everybody wants to short it. If it moves 4 handles down, everybody wants to buy it. Well, that will work more or less a lot of the time. The problem is there's an extreme negative expectancy in doing that, because it can work 4 days in a row, and then one day you give up everything that you've made for the past 2 months in one day. And today is one of those types of days. Now, today is a very directional day. There's a lot of conviction behind today. It is what is known in market profile parlance as a trend day, which are relatively rare days. They're directional days where one side of the market, either the buyer or the seller, is in control of what's going on all day long, and it's pretty relentless directionally. And this brings to another point, and it emphasizes why indicators, and in particular the oscillators that almost everyone uses or has used, are completely, utterly, totally worthless. And they're worse than worthless. They're counterproductive. They will destroy your trading. And what I'm referring to are RSI, stochastics, MACD. All of those things are basically different sides of the same coin. They are all derived from some form of a moving average. They're just moving averages massaged, and they don't tell you anything about the market. They're generated, they're constructed by a number series of randomness, and that number series is price movement. But it has nothing to do with the market itself. They have nothing to do with the structure of the market. They have nothing to do with the purpose of the market. They are just rote oscillators constructed from a number series that's generated by price movement. Nothing more, nothing less. Now, the implication is that they can tell you something about the condition of the market. And that's a good thing. It's a good thing to want to know or want to understand the condition of the market, but you cannot find it in an oscillator. You can find it in auction market principles, and then you can use bar charts and the profile graph to help you understand and to help you visually see where the auction is. Now, today, for instance, and this is the profile graph. In a minute, I'll show you a bar chart. Today, for instance, you can see this is a directional day. We've had 2 periods now that have overlapped the previous period, but it's just been up all day. Everybody wants to fade this. Here's a bar chart. And for most people, this is an insanely long-term chart. It's actually 30 minutes long. There are a lot of people out there in trader land that consider anything above a sub-minute time frame long term. Well, this is just a 30-minute chart. But you can see we've had a very directional market. Now, the trading for today is from the dotted line over. This is actually the 9:30 to 10 o'clock bar on a 30-minute chart. So what you're seeing here is just basically this. And then when I collapse the profile, you get the profile view that gives you more of a perspective on what's going on the horizontal scale of the chart, which is what shows us value, but that we're getting into sort of getting off topic here. But anyway, this is a typical profile chart. But my point is, you cannot use oscillators. They don't help you. They will destroy your trading. What you want to understand is our auction market principles and auction market concepts. Now, one of those concepts is conviction. And we had conviction very early this morning. And you can see we had conviction here, then we had a little bit of a pause near this high. Then we had more conviction. So you have conviction and more conviction. Now, if you're trading off of an oscillator, you're overbought here, so you're selling. Well, now you're really overbought, so you're selling some more. Now you're really overbought, so you're selling some more. Well, at this point in time, you're just praying that the S&P comes in 3 handles so you can get out of your 475 contracts at something resembling break even. What could happen is that this thing has another conviction bar to the upside before you have any significant retracement, or it may not have any significant retracement at all. And it only takes a day or two like this, a month, to destroy all the gains of the scalpers that are using some sort of oscillator, thinking that they're getting information about the market that is useful. You're not. You're not. So that's my trade lesson for today. Don't use oscillators. Learn and understand auction market concepts. Learn what conviction is. Learn what initiative is. And forget overbought and oversold. There's no such thing as overbought or oversold in any time frame. Hope you've enjoyed this trade lesson. There'll be much more coming.